Welcome to my channel and welcome to a new video titled Oil Price Shock and Inflation. If this topic interests you, please subscribe to the Boom and Bust Report. All the details are available at boombustreport.com. And now let's dive right in. The ongoing war in Iran is raising serious concerns among investors, particularly about the risk of an oil price shock, that is, sharply rising oil prices that could fuel higher inflation and accelerate the debasement of fiat currencies like the US dollar, the euro, the Chinese renminbi, the Japanese yen, to name just a few. In this video, I will provide some explanations of key concepts, and at the end I will offer a brief comment for investors on what to expect. Let's start with a fundamental question. What is inflation? The term inflation is used all the time, but people often mean very different things by it. So first, let's clarify the definition of inflation. Most people think of inflation as a sustained broad-based increase in the prices of goods and services over time. In this view, inflation represents a loss of purchasing power of money. Over time, your money buys less and less because everything gets more expensive. From an economic perspective, however, it's useful to distinguish between goods price inflation, say rising consumer prices, and money supply inflation, that is, an increase in the quantity of money. The importance of this distinction becomes clear when we examine the causes of inflation. There are essentially two main explanations for what causes inflation. The first is the non-monetary view. Proponents argue that inflation stems from excess demand or rising costs. If demand outstrips supply, prices rise. This is often called demand pull inflation. Alternatively, if production costs increase, for example, higher wages or higher raw material prices, companies pass those costs on to consumers, leading to cost push inflation. The second explanation is the monetary explanation. Here, inflation occurs when the central bank or the commercial banks expand the money supply faster than the economy's output of goods and services increases. As the famous economist Milton Friedman put it, inflation is always and everywhere a monetary phenomenon. Those who favor the monetary view, and there are strong, I would say compelling reasons to do so, see money supply inflation as the root cause and goods price inflation as the symptom or its effect. As mentioned earlier, the war in Iran has already driven a sharp increase in oil prices along with other energy sources like natural gas. The West Texas immediate crude oil price is currently at $80 to $85 per barrel compared to just $67 on February 2027. For historical context, during the first oil price crisis in the early 1970s, prices quadrupled from about $3 to $12 per barrel. In the early 1980s, the second crisis, they roughly doubled to nearly $40 per barrel. And during the Gulf War in the early 1990s, prices also doubled. The current increase, roughly 30% so far, doesn't yet qualify as a full shock by those historical standards. So how does a rising oil price fit into our understanding of inflation? A sustained increase in oil prices will almost certainly push up officially measured consumer price inflation numbers, as past experience shows. But viewed in isolation, this is primarily a cost-push effect, with very different consequences from money supply-driven inflation. And here's why. If oil prices double, people and businesses can only maintain their current energy use by cutting back on other goods and services. Economists call this a negative real balance effect. Higher oil prices make consumers and producers poorer in real terms. As a result, energy prices rise, but prices for other goods whose demand falls tend to decline or stabilize. Overall, we don't see a sustained broad-based rise in goods prices. True inflation doesn't take hold. The picture changes dramatically, however, if the central bank responds to the oil price shock by expanding the money supply. More money allows people to sustain their energy consumption without slashing demand elsewhere. The outcome: all goods prices rise and the purchasing power of money falls across the board. In simple terms, an oil price shock without money supply expansion has a recessionary effect. Any price increases are limited and often offset by falling demand elsewhere. An oil price shock with central bank money creation softens the immediate economic pain but fuels higher goods price inflation and eventually leads to production and job losses when that inflation must later be curbed. Looking ahead, what should we expect for goods price inflation? First, recognize that today's fiat money system is inherently inflationary by design. It systematically erodes the purchasing power of money. That's built into how it operates. To mask this reality and prevent people from abandoning fiat currencies, governments and central banks publish statistics that understate true inflation and the real loss of purchasing power. Also, we are constantly told that central banks are fighting inflation, even though they are the primary creators of inflation through ongoing money supply expansion. They may speed it up or slow it down at times, but they do not fight inflation. The claim is simply false. Importantly, this chronic inflation primarily benefits the state and its favored groups, the cronies, while the broader population pays the price through reduced purchasing power. In the face of an oil price shock, you might want to expect the following. Preserving the value, the purchasing power of money is not the priority of central banks. Instead, the focus will be on keeping heavily indebted governments liquid and funded. Here's how it typically unfolds. Higher energy prices reduce consumers' and producers' real purchasing power. Demand for non-energy goods collapses. Sales stall, companies cut production or go unprofitable, and the economy slides into recession. Government spending rises for unemployment benefits and for inflation-indexed outlays, while tax revenues fall. Politicians borrow even more to fill the gap. To ensure these over-indebted states can borrow cheaply, central banks cut interest rates artificially, create more money in cahoot with commercial banks, and eventually goods prices rise. To give an example, let us think of, say, the euro area. If investors sell their government bonds during an oil price shock, bond yields will be pushed up. To prevent this, the European Central Bank steps in to buy bonds openly or covertly, raising bond prices, suppressing yields, and paying with newly created euros. And the rise in the money supply boosts goods price inflation. Of course, central bankers, politicians, and mainstream economists will scramble for scapegoats. They will blame the oil price shock itself for high inflation, not the money creation. They will insist bond purchases aren't printing money to finance public debt, but merely stabilizing the system. What's crucial to remember is higher goods price inflation conveniently devalues public debt in real terms at the expense of savers and everyday money holders. This works best when leaders can convincingly shift blame elsewhere and the public doesn't fully grasp the deception and the wealth transfer involved. In conclusion, given the prevailing fiat money system and the political incentives, a genuine oil price shock, which isn't fully confirmed yet despite recent surges, would most likely drive goods price inflation higher for the foreseeable future, accelerating the devaluation, the debasement of your money's purchasing power. If you would like to learn more about how to invest and protect your capital in this fiat money environment, check out Dr. Polleit's Boom and Bust Report. Full information is at boombustreport.com. Thank you very much for watching. I appreciate your interest and attention. And now here's a short promotional clip to say goodbye.